Insurance Level 1 Test Alberta Exam Questions. Insurance. A contract in which one party, the insurer, for monetary consideration agrees to reimburse another, the insured for loss or liability for a loss on a defined subject caused by specific hazards or perils. Actuarial department of an insurance company. Analyzes data and performs calculations to set rates for various classes of insurance. The rate makers, they also determine the amount of money required to cover reserves and alerts management if reserves do not meet regulatory requirements. Unearned premium. The part of a premium that has not been used or earned. Premium representing the unearned portion of a policy. Combined ratio. This is the sum of the insurer's loss and expense ratio. Reinsurance. Insurance purchased by an insurance company from another insurance company, reinsurer, to provide it protection against large losses on cases it has already insured. Insurance of insurance companies. A transaction where the reinsurer agrees to indemnify another party, the reinsured, in consideration of a premium paid to it for all or some liability. The reinsured is the primary or ceding company. Matching. A part of active listening when someone matches certain body positions or postures of those of the person they are listening to, unconsciously. Payment of premiums. 1. Payment is due when coverage becomes effective. 2 types of payment are direct bill and broker bill. Ways to prospect for new clients. 1. Target marketing. 2. Market segmentation. 3. Advertising. 4. Cold calling. 5. Referrals. Upselling. Selling an upgraded version of an existing policy or improving coverage. 3. Alberta government bodies for insurance. 1. Alberta Finance. 2. Alberta Insurance Council. 3. Superintendent, Insurance and Financial Institutions. 3 Main roles of underwriters. 1. The accepting or rejecting of risk. 2. The investing of capital. 3. The implementing of an insurer's strategic plan. Adjuster. 1. Who investigates insurance claims, makes recommendations regarding payment of benefits from insurance policies, and negotiates payments and settlements. Errors and omissions insurance requirements. All agents and brokers must carry at minimum 2 million of this coverage in the event of a lawsuit from insurance companies due to a client having lack of coverage and due to their actions by either doing something wrong, error, or not doing something, omission. The best defense for this is documentation, communication, and acting within scope and authority. Earned premium. 1. That portion of a premium earned or charged for the period of time a policy remains effective. 2. An amount calculated by taking the earned premium reserve at the beginning of the period plus the premium written during the period, less the unearned premium at the end of the period. 3. Premium actually exposed to loss. For insurance councils in Alberta. 1. Alberta Insurance Council. 2. Insurance Adjusters Council. 3. General Insurance Council. 4. Life Insurance Council. Session. The cession is the amount that has been ceded through reinsurance. Agent. A person who is employed or authorized to act on behalf of another. Agents can be independent or direct writers. Healthy insurance marketplace. A marketplace where consumers' needs are met by products that are readily available and affordably priced, and where both insureds and claimants are treated fairly according to societal expectations. Advising a client includes risk analysis. What is risk analysis? It is the process of identifying and quantifying exposures to loss. Roles of insurance intermediaries. 1. Prospect for potential clients. 2. Qualify the client. 3. Advise the client. 4. Facilitate the insurance application. 5. Obtain instructions from the client. 6. negotiate insurance. 7. Facilitate the claims process. Alberta Automobile Insurance Rate Board regulates insurer rating programs and annually reviews and establishes guidelines for premium level related to private passenger and commercial vehicles. Insurers must use the grid rating program established for basic coverage. Underwriting profit. This arises out of insurance operations. It is the amount by which earned premiums exceed, or fall short of, the cost of incurred claims and expenses. Mandate, Quebec Civil Code. Mandate is a contract by which one person, the mandator, principal, confers upon another person, the mandatory, the agent, the power to represent him in the performance of a juridical act with a third person, and the mandatory, by his acceptance, binds himself to exercise the power. Solvency. A business entity's ability to meet its long-term financial commitments. Functions of intermediaries. 1. Employed agents, direct, do not provided producer services. 2. Independent agents limited claims. 3. Brokers claims, loss control, and other functions. Law of principal and agent between brokers and insurance companies. 1. Agents/brokers are contracted to act on behalf of the insurance companies within the guidelines of the agency/brokerage contract. 2. Insurance companies are obligated to the insureds through the contracts created by the agents/brokers. Contract. An agreement or promise between two or more persons that is intended to be legally enforceable and is constituted by the acceptance by one party of the offer made to him by another party, to do or abstain from doing a specific act. The offer and acceptance may be either expressed or be inferred through the conduct of both parties. Benefits to members of the Insurance Bureau of Canada. 1. Issues management related to public affairs, marketing, legal, and policy development. 2. Investigative services including crime-related investigations, loss and recovery services, and information exchange related to investigative services. 3. Insurance information related to web-based business applications and automobile insurance info in Canada. Investment income. This is the income the insurer earns from investing money that the insurer has received as premium but not yet earned, as well as money it has set aside as a reserve to pay claims. Information regulators monitor. 1. Statistics on the frequency and severity of claims. 2. Trends in loss cost developments. 3. Average length of time a claim is open. 4. Incidence and cost of fraudulent and other illegal activity. 5. Changes in average private premium. 6. Consumer Price Index. 7. Premiums for specific demographic profiles. 8. Insurance costs versus disposable income. 9. Reinsurance costs as a % of premium. 10. Profit or loss from market mechanisms. 11. Capital bases of insurers in the province. Investing of capital. Investing capital towards some risk while declining to invest risk towards others. This indemnification means a promise to pay but also limits the ability to invest capital towards other risks due to capacity. Manuscript policies. These are unique wording specially drafted to accommodate the unique needs of a particular risk. Subscription policy. An insurance arrangement where one insurer known as the lead company issues the policy, but one or more other insurers subscribe to it or participate in covering the risk. Retrocessionaire. The reinsurance company that accepts a retrocession from another company. Mandator. The principal in contracts made in Quebec, in accordance with the Civil Code of Quebec. Unearned premium reserve. A reserve fund of an insurance company or reinsurance company, representing the unearned premiums. Key characteristics of insurance brokers. 1. Independent business that own their client list and is paid a commission for all policies sold. 2. Individual brokers work for the brokerage and compensation is varied because of this. 3. Brokers can cancel a contract and move an insured business to another insurance company. 4. Provide consumers with a choice of products and insurers. IBNR claims. Claims that have been incurred but not yet reported. These must be included in an insurance company's claims reserve. Fiduciary duty. Being responsible for providing the principal with all information that materially affects the principal's interests, all information that is relevant to the affairs entrusted by the agent. Duty to inform is strengthened by the legal principle of utmost good faith, accepting or rejecting risk. To survive and make profit, the insurer must offer coverage to insureds as a group that are likely to incur less losses than they pay in premiums. They must seek insureds that pose acceptable risks of loss and avoid unacceptable risks. Indemnify. To provide compensation for loss or expenses incurred. Non-proportional reinsurance. The reinsurance's portion of loss depends on the size of the loss, i.e., reinsurer may cover losses about $50,000 but not more than $100,000. Insurance model. Fund income, premiums, insurance fund, insurance, fund outgo, claim payments, retention. The amount of liability the ceding company, primary insurer, retains for its own account, may be a % or dollar amount. Direct bill of premiums. Payment is sent from the insured directly to the insurance company. This can include direct billing when the insurance company withdraws from the insured bank account. This is started with a withdrawal equal to the first 60 days of coverage to cover admin costs if the insurance were to be cancelled prior to expiry. Measuring capacity guidelines. 1. The ratio of net premiums to equity, capital and surplus. Once it reached 3 to 1, a regulator may become concerned. 2. The maximum single exposure. The maximum percentage of equity that an insurer can put on a single exposure might be 2% net retention on a single risk. Utmost good faith. A phrase in a legal document calling for the highest standards of integrity on the part of the insured and the insurer. Cede. When a company reinsures its liability with another company. Waiver. The intentional and voluntary relinquishment of a known right. A waiver under a policy is required to be clearly expressed and in writing. Direct agent. Represents only one company and sells for only one company. Premium. The price of insurance protection for a specified risk for a specified period of time. Ways insurance and brokerages are the same as other businesses. 1. Subject to the same laws as other businesses. 2. Incorporation, income taxes, consumer protection and employment regulations are the same. Subrogation. When a third party is liable or responsible for damages, the insured party transfers rights to the insurer to go after the third party for compensation. This is the insurer's right under the law. Key characteristics of insurance agents. 1. Generally sell the insurance policies offered by a single insurer, either employed by the company or work independently. 2. Receive more training and education support than brokers from the insurance companies. 3. Direct writers work for the insurance companies and are paid salary plus commission. 4. The business written belongs to the insurer. 5. Independent agents are called agencies. Typically hire a commission to encourage growth. Business list still generally belongs to the insurer still. The Office of the Superintendent of Insurance regulates and creates policy for the insurance market in Alberta to ensure that Albertans have affordable access to the insurance coverage they require. Handles concerns and complaints about insurance companies. 3 ways to locate sales prospects. 1. Referrals. 2. Advertising/walk-ins. 3. Cold calling. Broker. A licensed independent person or firm who acts on behalf of the insured in placing business with insurance companies. Severity of loss. This is the average size of losses. The larger the average loss, the higher the loss severity is said to be. Assuming the frequency is constant, the higher the severity, the worse the loss experience. Independent agent is one who contracts with at least 2 or more insurance companies to sell their insurance policies to the public and is paid a commission based on the percentage of each premium paid. This includes a fee for each policy serviced. Material fact. A fact that would affect a contract of insurance enough to influence an insurer's decision regarding whether to accept or reject the risk of the premium to be set. Material facts must be disclosed by the applicant if asked about. Primary function of insurance. To spread risk losses of few or shared by many. Staff adjuster. Works for the insurance company and works directly with the insured to settle the claim. Active listening. This includes listening to what is being said, interpreting how it is being said, processing non-verbal cues, questioning parts that require clarity, and confirming that what was absorbed was understood correctly. Loss ratio. This is the ratio of the insurer's incurred claims to its earned premiums over a specified period. Treaty reinsurance. An agreement between an insurance company and insurance company. The reinsurer automatically accepts a portion of the ceding company's liability for a specified class or classes of business. Terms of agreement are already established for loss limits, premium payment, etc. Duty of care. The obligation that a person has to exercise reasonable care with respect to the interests of others, including protecting them from harm. How insurers spread risk. 1. Volume insuring large numbers of risks. 2. Diversity of types of risks insured. 3. Diversity of location. Avoid too many risks in one location. 5 reasons to reinsure. 1. To increase the insurer's capacity to write business. Able to write a higher level of risk than it would be able to on its own. 2. To maintain a proper reserve/liability balance. 3. Reduce the effects of a catastrophic loss. 4. Provide stability in a fluctuating market. 5. To enable an insurer to cease operations. Companies withdrawing from a market. Secondary functions of insurance. 1. Aid to security. Insurance gives people peace of mind and allows for some degree of certainty in the future. 2. Aid to credit. Cannot take out a house or car loan without insurance. 3. Loss prevention activities. Fire prevention. Safe driving. 4. Source of capital. Large amounts of investments in economy including bonds, stocks, buildings, land, etc. 5. Source of employment. Insurance industry has a wide variety of jobs. Steps in a claim. 1. Insured reports the claim to either the broker or the claims department at the insurance company. The claims department then collect preliminary information. 2. An adjuster is then assigned and will meet with the client to review the damage and discuss the loss. Small losses may be handled with a telephone adjuster. 3. The adjuster then evaluates damages and confirms that the loss is covered by an insured peril. 4. If the claim is not covered, the adjuster will report, but if it is covered, the adjuster will negotiate and forward payment to either the insured or the broker. 5. If a third party is responsible, the insurer will then initiate subrogation proceedings. For key steps to facilitating the claims process. 1. Avoid making any comments about the validity of claim unless it is obvious they are not covered, and then just tactfully suggest that it might not be, i.e., trying to claim house fire under auto insurance. 2. Outline the basic claims process. 3. Inform the insured. 4. Monitor the progress of the claim. Underwriting authority. The policy or bond limit up to which an insurer has granted its underwriters, agents, and brokers permission to issue policies or bonds. Risk. The chance of loss. Specifically, the possible loss or destruction of a property or the possible incurring of a liability, sometimes referred to as the subject of an insurance contract. Facultative reinsurance. Reinsurance of risk on a case-by-case basis subject to acceptance or rejection by the insurer. Key objectives of risk-based regulatory models. 1. Informed and empowered consumers. 2. Timely and fair claims management. 3. Meaningful choice for insurance consumers. 4. Low system costs. 5. Market stability. Expense ratio. This is the ratio of the insurer's acquisition costs and other expenses to its earned premiums over a specified period. Finance companies for premium payment. Typically only used for commercial accounts or high-value personal lines due to a minimum limit. The finance company pays the full premium to the broker and then collects money from the insured as a loan. Finance companies then accept the unearned premium as a collateral. The insured assigns rights to the finance company. Roles of the Insurance Bureau of Canada. The national industry association that represents the interests of Canada's private P&C insurers. Roles include 1. Advocating industry positions with consumers, government, members and other stakeholders. 2. Identifying and monitoring issues, developing policy positions, and responding to legal developments. 3. Staying on top of issues of strategic importance to the industry including regulatory improvement, consumer outreach, climate change, insurance crime etc. Mirroring. Active listening when matching is actually performed consciously. How utmost good faith is related to a broker's duty of care to insurers and clients. Brokers must disclose all material information to the insurers but also must explain all coverages or lack thereof to the insured and make recommendations that will protect them from exposures. Regulatory guidelines to determine solvency. 1. Reserves. Premium and claims or reserves are reviewed annually. Premium reserve is the test of adequacy of premium rates and the claim reserve is a test of adequacy of reserves held to pay outstanding claims as well as claims that have been incurred but not reported. IBNR. 2. Receivables. The collectability of accounts receivable and reinsurance recoveries are reviewed. Accounts receivable outstanding of 65 days cannot be treated as assets for the purpose of calculating capital and surplus. 3. Investment risk. The manner to which insurers may invest their assets is subject to regulation to ensure safety of capital and appropriate level of liquidity. 4. Measuring capacity. A function of both capital available and extent of exposures that insurers are willing to accept. Minimal capital requirements are required to establish capacity to write new business. Ex-dating. Tracking expiry dates of previous customers and also prospective customers so that 2 months before their coverage expires you can reach out and offer a quotation. 2 methods of reinsuring. 1. Proportional reinsurance. 2. Non-proportional reinsurance. Retrocede, retrocession. To cede a part of a risk to another insurer or reinsurer. Insurance for reinsurance companies. Third generation. Proportional reinsurance. A percentage of risk is transferred to a reinsurer and the reinsurer receives the same percentage of premium and is responsible for the same percentage of each loss. Agency or brokerage contract. A contract that allows one person to employ another to do her or his work, sell her or his goods, and acquire property on her or his behalf, as if the employer were present and the acting person. The principal may authorize the agent to perform various tasks or they may restrict the agent to specific functions, but regardless of the amount or scope of authority given to the agent represents the principal and is subject to the principal's control. The principal is liable for the consequences of acts that the agent has been directed to perform. Tools of an underwriter. 1. Product knowledge. 2. Tailoring policies to meet client needs. 3. Industry knowledge. 4. Claims knowledge. Loss experience. Broker bill of premiums. Payment is collected from the insured to the broker and placed into a trust account by the broker until remittance to the insurance company. Typically 30 to 60 days, but this is included in the brokerage contract. Estoppel. A bar created when someone by his action or lack of it indicates that he will not exercise a right he has. He stops himself from exercising this right later. Alberta Insurance Council. 1. The financial arm of the councils and provides investigation and administrative services to the other councils. Handles concerns and complaints of insurance agents, adjusters, and brokers. Responsible for licensing of agents and brokers. Independent adjuster. Qualified independent businessperson is appointed by the insurer to settle a claim. Mandatory. The agent in contracts made in Quebec in accordance with the Civil Code of Quebec. 2 types of reinsurance. 1. Treaty reinsurance. 2. Facultative reinsurance. Cross-selling. Selling insurance policies to family and friends of existing clients or sell existing client coverages to other risks. Umbrella. Public adjuster. Independent businessperson who may be engaged by the insured to help in the settlement of a claim. Infrequently used, they are typically hired in cases where the claim is large and the amount is in dispute. Insurance intermediaries. Brokers and agents. Frequency of loss. This is a measure of how often losses are likely to occur in the future. Assuming the average size of loss is constant, the higher the frequency, the worse the loss experience. Exposure units can mean whatever is appropriate to the risk: the number of automobiles in a fleet, the number of policies in a portfolio, the number of locations, etc. Responsibilities of Alberta insurance regulators. 1. Monitoring each insurer's compliance with provincial insurance legislation. 2. Monitoring the solvency of provincially incorporated insurers. 3. Licensing insurers to operate in its jurisdiction. 4. Licensing and supervising adjusters, brokers, and agents. 5. Approving classes of business. 6. Controlling insurance advertising. 7. Review insurance contract wordings. 8. Approving policy forms. 9. Enforcing underwriting eligibility criteria. 10. Overseeing claim settlement practices. 11. Overseeing the electronic marketing of insurance. 12. Overseeing the ethical, operational, and trade practices of insurers. Facility association. A pooling arrangement that several insurance companies participate in that provides insurance to high-risk drivers that may not be able to obtain auto insurance elsewhere. Drivers must have access to basic insurance to drive even if they are high risk due to previous driving records. This allows insurance companies to share the risk of these drivers. CIP program. Chartered insurance professional. It is important because it teaches the product knowledge for every function in the profession. It represents credibility and expertise, which shows the prospects and clientele that you are a professional that can meet their insurance needs at a higher level.